Unlike my fellow panelists, I am unable to celebrate my forecasting acumen. I had projected 60-degree temperatures for Chicago early this week. I thought I would build on Randy's and Austin's comments, first by offering some perspective, and then I'll offer some questions surrounding the outlook for 2014. 5 years ago, the world was in the midst of a critical inflection point. At the time, the first derivative of national income was in question. Could we move past the financial crisis and restore growth, or was there a second shoe to drop? I was working at the Fed at that time and spent most of the fall of 2008 in New York in the middle of the maelstrom, worried about derivatives of a very different kind. People have asked me when I realized that we were in crisis, and I answer it was the Thursday after Lehman Brothers failed. It was not because AIG or any other financial institution was on the verge of failure. It stemmed from a telephone call that came in very late one evening to the New York Fed. I knew, just from the way that the phone rang, that it was my mother, and that she was not happy. She said, "Son, how are you?" Now, I don't know how it is for anybody else, but when my mother asks that question, the one thing she's not interested in is how I am. It's a mere pleasantry and a transition to the real meat of the matter, which in this case was, "Son, do I have any money in money market mutual funds?" How many of you help a relative with financial planning? It is, I'm sure you would agree, among the most thankless assignments you can receive. I said, "Yes, Mom, you have some money in these products," and then she continued by asking the question that I dreaded, "Are they insured?" I said, "Not exactly," and I could almost hear, on the other end of the line, her scratching my name out of her last will and testament, and substituting my brother Fred's. Now, what I couldn't tell her was that among the work streams at the New York Fed at that time was the support that ultimately created some stability in the markets for mutual funds and commercial paper. And when it was announced, I called her that Friday, breathlessly hoping that she would recognize that I had been fighting for her best interest, but in fact, she's still not pleased with me. As the calendar turned to 2009, there were a number of difficult questions that we were asking back then. What could central banks do after reaching the zero lower bound for interest rates? How much deleveraging would be required in the public and private sectors? What regulatory reaction would follow, and how would it affect economic performance? In what manner would the trauma that originated here cascade across the globe and potentially revert to our shores? How should fiscal policy respond, both in size and design? And which major banks might fail? How soon we forget that fragile period where the crisis was perhaps abating, but there was a great deal of concern about our financial institutions, one which fortunately we don't have to worry about today. I was among a small group of people who was asked to put together the first stress test, an appropriately named exercise. People have asked when the bottom of the financial crisis was, and I respond quickly, it was April the 25th of 2009. That was not, if you're checking your stock tickers, the date that the S&P 500 reached its bottom. That was the date that we had to deliver our final numbers to Washington on the stress test, and as was often the case in that exercise, the numbers weren't cooperating. I had been working days and nights, sleeping frequently in the office, and had promised my wife that I would make it home that Friday evening so she could have a well-deserved night out with her girlfriends. I promised to catch the 5 o'clock train, which became the 6 o'clock train, which became the 7 o'clock train, and after she had canceled her plans, I called her at midnight, and with chutzpah that is almost unmatched, I asked if she wouldn't mind driving a fresh pair of clothing down for me to wear. She hung up on me. Now, a half an hour later, I got a call from Karen saying that she was 5 minutes away from the front door of the Fed, and would I kindly go down to the entrance and meet her there. So as I'm going down, I'm thinking, boy, I sure outkicked my coverage when I got married, and the Mother's Day gift was going to have to be especially generous. But with God as my witness, she cruised up in the van, she threw a bag onto the sidewalk, and drove away without saying a word. And that, my friends, was, for me, the bottom of the financial crisis. Happily, that following week, when the stress test results were released and banks were subsequently recapitalized, the foundation of the American economy was solidified, and shortly thereafter, we began a recovery that's now 4.5 years old, and the stock market has more than doubled during that interval. And so we gather today, we're at another economic inflection point, but happily this one surrounds the second derivative of national income, as it seems relatively unlikely that we'll fall back into recession. So let me again build on the comments of Randy and Austin by asking a few key questions. First, can the American economy finally reach a higher gear? I would agree with my colleagues. Consider the following. Household deleveraging has brought ratios of household debt to income down to levels that we haven't seen in more than 10 years. The fiscal drag, which reduced real GDP this year by about 1.5%, is abating. Monetary policy, even with tapering, is remarkably accommodative, and employment is improving, which will add to spending. The second half of 2013 is likely to show a real rate of growth in the United States in excess of 3%. And our forecast is that we will at least match that level, if not better it, in 2014. In fact, the more I see the numbers and read the opinions, the risks may be on the upside, as business investment, which has been remarkably sluggish, has a lot of room to grow, given the cash on corporate balance sheets and the opportunities for improvements. Some remain very concerned in the U.S. about our long-term fiscal imbalances. I'm glad that Austin brought this up. There have been a couple of very quiet trends that may tend to make the picture a great deal better. Northern Trust has a very large pension business, and there is nothing that improves the solvency of pension plans better than higher interest rates. Very quietly, the 10-year U.S. Treasury yield has almost doubled since spring, and while that's probably harmful to housing, it is very favorable to those of you who are working with defined benefit plans of the kind that Social Security represents. And as Austin also mentioned, the healthcare inflation picture extrapolated over 40 or 50 years could really change the picture of our long-term fiscal health. Unfortunately, in markets outside the United States, this picture is not quite so clear. And so my second question is, can Europe avoid a lost decade? Granted, some of the recent numbers have been a little bit more encouraging, and in discussing Europe, I want to abstract the UK, which is showing very nice growth, and the Bank of England may in fact become the first central bank, major central bank, to raise its interest rates as economic conditions improve. But as we move into the Eurozone, on a year-over-year basis, GDP has still declined. And as was announced yesterday, they have inflation that's only 0.7% and falling. Further, they have banks that have yet to recognize a lot of the detritus that was left over by the financial crisis, as national regulators have been unwilling to push their national champions to do an accurate accounting. On the horizon is an asset quality review, which will be conducted by the European Central Bank and followed with a stress test. Formulas are being developed to do the recapitalization that is now 5 years in our past here in the United States. And yet Europe is still dealing with fragmentation in borrowing costs, performance, inflation, which will be particularly difficult to reconcile given the varying philosophies, economic philosophies of the participating countries. And the ECB, which has done a heroic job given its limited tools, may have very little rope left to employ. This will, in fact, be a critical year for Western Europe to see if those structural changes that were clearly needed after the crisis can finally be implemented. Third, will politics muddy the economic waters? The extremes of economic performance within and across nations have given rise to political dissonance over the past several years, where fringe parties and fringe points of view seem to be getting even greater hearing in a broad range of countries. Many of those outsiders are skeptical about international cooperation and skeptical about the traditional conduct of monetary and fiscal policy. While some of their points of view are certainly worthy of consideration, their stridence in expressing them has made reaching consensus a lot more difficult. Aside from the November midterm balloting here in the United States, choices for the European Parliament come up in May, India will have national elections in the spring and Brazil in the fall. Egyptians this month will be asked to endorse a new constitution. Turks and Indonesians will be selecting new leaders, and Scotland will have a referendum on independence. And as an aside, my son was watching Braveheart on television last night, and I hope that is not a metaphor for what is going to go on in Scotland. The potential for important power shifts is significant in several of those instances, which cast some doubt over economic policy and economic performance. And there is a growing school of thought backed by study that policy uncertainty in itself is the enemy of economic and market performance, and so we are certainly not free of those risks this year. Fourth, what is the natural mandate for a central bank, and what should they be doing in this environment? Central banks around the world agree on targeting inflation, but from there the missions become considerably more diverse, mixing in targets for employment, currency, financial stability, and even the stability of national debt. Balancing all of these is a terribly difficult thing to do, and also communicating with markets about them is very hard. As banks have gone to forward guidance, for instance, where cooperation from investors is critical to getting the appropriate modulation on economic activity, making that translation is very hard. The two sides almost seem to be speaking different languages. I'm reminded, and please no offense to any of you who are in the fixed income business, of the remark about what's the difference between bonds and bond traders. Bonds eventually mature. So, there are certainly concerns about the Fed trying to do too much, and other central banks as well. And it goes beyond our borders, as there have been suggestions from not only emerging but mature markets that the Fed should take their considerations into play as they decide on monetary policy. Certainly, the body like the ECB, which has few tools available, would love the Fed to remain as accommodative as possible to help it enforce its goals for Europe. And yet, I think we're asking too much, and in trying to do too many things, perhaps central banks aren't doing any of them very well. And in the process, they invite more of the political interference, which I hope this room will agree is the enemy of sound monetary policy. So I applaud the Fed's move to taper. We expect them to finish their tapering by summer and hopefully continue the process of normalizing monetary policy and minimizing the sort of political interference which would be harmful to central banks. Finally, can Asia continue its economic recovery? In Japan, Prime Minister Shinzo Abe has succeeded in ending deflation and has promoted stronger Japanese growth, which on a year-over-year basis is about 2.5%. Ahead lies some structural reform of the Japanese economy, the third arrow, which may be a little bit more challenging to implement, but he does so on the back of great support and a lot of momentum. Across the China Sea, the new regime in China has convinced the world markets that 7 to 8% real growth is acceptable and in fact desirable when compared to artificially inflating growth to a new level. Nonetheless, the mission of balancing Chinese growth better between export and domestic consumption is still a work in progress. And calming financial concerns about China, where property prices have clearly escalated rapidly, financed in no small measure by money from a shadow banking system. We've seen that movie in the United States, and it does not end well. Hopefully, it will not end that way in China. Certainly, they have the resources to stabilize their financial system, but that will certainly bear watching in the year ahead. I've offered a few questions for the outlook. There will be no doubt others that will arise during the course of the year. But in closing, I would like to remind everybody that we've graduated over the last 5 years to a higher class of questions, and for that we should all feel very pleased. I certainly hope that spirit filters through to my mother and my wife in 2014. We look forward to your questions as we continue.